Wim, maybe I can start with you as being the banker here on stage, and a lot has already been said by Martin Wolf about banks, especially about how in euphoric times they, through excess money creation, contribute to the crisis that will follow. In the analysis that Martin Wolf put on the table, are there second thoughts you want to put against that, or you wholly agree with his analysis and we can move on to the solutions?
Well, thank you, Rens. Of course, I would have liked to also have about 15 minutes, show some other slides about other crises where public financing by governments made an immense mess of an economy. And that's one of the, well, we will discuss this later today. Monetary financing is in Europe forbidden by law. It's in the treaty, it's not allowed. It's one of the reasons why the central bank is struggling today with this quantitative easing. And this is because of a history. So I would have liked to have the floor for, well, some counter presentation, and then we could have a more balanced discussion.
We get to discuss the negative aspects of public money creation in the second part.
Because the analysis, what went wrong, well, I share most of the observations of Martin. But I have some additional remarks. First is the indicator of banking assets of GDP. In small countries, it's a different story than in large countries. Because a bank like Deutsche Bank is an immense bank. In the Netherlands, it would be twice GDP. In Germany, it's medium-sized compared to the economy. So would having big banks be a privilege for large countries? Seeing the danger that large companies also will move to large countries because they don't find the banking activities. It is one of the, you see, I think the UK is the odd man out, a large country with a huge banking system, but otherwise there's a strong correlation with the size of the economy. Your story was very strong from the UK, and one of the things I missed in your presentation is that in the UK something went wrong during the 1990s. It was the carpetbaggers in the mutual system. The United Kingdom had, like the Netherlands and Germany, a system of quoted banks, mutual banks, cooperatives. And in the UK, all these cooperatives were turned over into commercial banks by a flaw in regulation, I would say. So the whole system is based on equity-based bank, which makes it a financial monoculture. And I think one of the issues also is that diversity in banks, not because the one system is better than the other, but just to have diversity in banks, also in governing models, makes the whole system more stable. So, and in the UK, things almost also went wrong because it was a 100% quoted commercial banking thing. The ring fencing thing also, in the Netherlands, if I look where banks make losses, it's not in investment banking. The most risky part in banking is just giving credit to small and medium enterprises and consumers. There are the big losses, the big provisions. So the story about ring fencing would make the difference between a high risky investment banking part and a very stable retail part. Well, wake up, the retail part isn't stable at all. Many losses are taken there, and they are a direct result of the basic functions of bank in the economy. Well, I think if you look at regulation, one of the things that I miss in the discussion and also in all the proposals, we try to introduce anti-cyclical capital buffers. They are in part of Basel III, so that banks have to build up buffers when things go right, so they have bigger buffers when things go wrong. What I miss is that the anti-cyclical liquidity buffer. I think that would be a much more liquidity buffers, because that would actually set a real break on the money creation principle of banks and also their credit they can extend. And it's not a bad thing if you run down your liquidity, as long as you have enough. It's much more difficult to run down your equity during a downturn. So anti-cyclical capital regulation, in my view, will not work, but liquidity buffers might do a better job. And then a final, and this is basic, after this presentation, which I agreed upon to a large extent. And then the final bullet was, and the money creation principle should be taken away, and we should go to a government system. Well, this is the next discussion, but in my feeling, this was a, as we say in Dutch, very kort door de bocht, a little bit loose from the rest of the arguments, because you also can create too much debt in the system without any money creation by commercial banks. That's not the same thing by definition. And this is what we overlook so far, but it will come back in the discussion. Arnoud.
Okay, Wim Boonstra, thank you very much. If I may try to summarize you say, well, I agree with the main line of the argument of Martin Wolf. However, there are national differences. And you put on the table, I think, a very interesting new measure that might increase the stability of the current system to come up with these liquidity buffers. So the question to Martin will be, are you convinced? Do you think that that might fix the problem and we don't have to have a whole discussion about public money creation? But first, a question to Arnoud both, also about the state of the system as we have it. Because I was thinking, did Martin Wolf miss that there is a banking union in Europe? Because what I've understood from Jeroen Dijsselbloem, our Dutch chair of the Eurogroup, is that we have gone from a world of bailout to a world of bail-in. That is the promise of the banking union. And Martin Wolf was saying, well, I don't believe that's a credible promise. How do you see that? Are we in this bail-in world at the moment, or are we still in a bail-out world?
Obviously, if you look at the system at large, we are in a bail-out world. Because bail-in will work perfectly if you talk about an incidental financial institution that you can unwind because it got into trouble. But that would fundamentally miss what the major changes have been in the financial system over the last 20 years. The major changes have been that the financial system became increasingly interconnected. If you look at the size of the balance sheet relative to the credit granted to the economy, most of the size of the balance sheet went into inter-financial system positions, banks lending to banks. So the complexity of the financial system, not lending to the economy actually that we observe, which went up, but the interbank positions went up enormously. So the complexity of the financial system, the interlinkages have gone up enormously. And these interlinkages, the complexity of the financial system, which all comes together in financial markets, makes the financial system highly systemic, both in interlinkages and in terms of behavior. The financial system runs into the same direction in euphoric periods and runs in the same direction in non-euphoric periods. That's systemic risk. And once you think of the perspective of systemic risk, which is caused by financial markets, euphoria, which is caused by interlinkages, which is caused by the media. If you are a bank with a different strategy and your profitability is lower than that of your competitors, you will be framed in the media as that you are losing. Svenska Handelsbanken, just to give you an example, because to make things concrete always helps. Svenska Handelsbanken, early 90s, Swedish financial crisis. It was the only bank that did not run into real estate what all the other banks were doing, based on the deregulation of real estate in Sweden. Based on the same notion, by the way, real estate in Sweden had not gone down for 70 years. So in the minds of the Swedes, real estate was not a risky asset. Svenska Handelsbanken was the only bank that didn't run into real estate, didn't participate in the boom. During 3 years, they lost market share, they lost profitability, and they actually lost their best people because the other banks had higher margins. What was the framing in the newspaper 3 months before the real estate bubble broke and the crisis started? The framing in the newspaper was Svenska Handelsbanken is losing its touch. My question there is, if the real estate bubble would have broken 2 years later, would Svenska Handelsbanken have been able to stay out of real estate, or would they have been forced to give in? Because that was basically what the euphoria wanted it to do. So the systemic risk, similar type of behavior, is a problem that we see in the financial system, is based on social media, information technology, the proliferation of financial markets, and that in itself makes this whole notion of bail-in totally ineffective, because when you talk about bail-in, you will talk about the need of a bail-in of other institutions as well. It is not one institution that will be in trouble, it will be many institutions. And then the question comes up, who are the creditors of these institutions? Who are you going to impose the losses on? Probably on parties that will bring the other financial institutions down. So that makes it totally ineffective. When you need it, it doesn't work.
Okay, thank you. Before we go to Martin Wolf, Wim Boonstra, last question to you. You have been for a long time at Rabobank, still are. This pressure on banks, because Rabobank also is was a AAA bank. How was that pressure felt during the euphoric times before 2008, when other banks were doing things that maybe Rabobank was thinking, well, we shouldn't? How did such a discussion go, and what came out of that? Do you recognize the kind of dynamic that Arnoud is sketching?
I recognize it, but not in a direct way. I think this is what happens if you have a system of banks that all have the same business model, all have to do try the same thing, quoted on the stock exchange or whatever. Rabobank is not quoted on the stock exchange. We cannot raise capital on the stock exchange to a large extent, which we have to be careful. Not because we're better bankers, but simply if you lose money, we have to earn it again, because we cannot issue shares and attract more capital. So we have a different risk model, which makes us, during times of crisis, suddenly we are the strong bank. In normal times, people say, well, it's a little bit dull at Rabobank. They're both right. It's just the added value of having a different risk model. And about this government guarantee, I can imagine. Remember that when things went wrong in 2008, one of the public employees who was in charge of the saving of banks, he said, the television was running, so I can cite him, before the end of the year, all banks will be supported by the Dutch government. All large banks. I had a meeting with the board, and I visited there as the economist, and our chairman at the time, Bert Heemskerk, said, I heard what the minister said, and this is not going to happen. Over my dead body, we will never ever have state support. So it's not by definition that all bankers say, well, we have a guarantee, so let's have a party. I think that most people, or at least many people in the financial sector, really have pride in doing a good job. Which is a little bit out of fashion to say this, but...
But is that basis enough for trust of the general public in a financial sector, that the people, the people at banks...
I think that's what was highly damaging during the crisis, and we escaped that, is that if you looked at the building of big banks, you saw the quotation on the stock exchange, because banks were proud with that. So it was running in big letters, neon letters all around. And if you see that dropping and halving, it is not very good for confidence. Although, basically, it shouldn't be a disaster at that time. Well, we didn't have a quotation, so we just kept on doing what we did. And people didn't run away, also not during times where we were the dull bank, because many people just stick to their bank and want to have credit and knowing that the savings are safe, and that's it.
Okay. Martin Wolf, we've heard, I think, support from Arnoud about your analysis. In broad lines, also from Wim Boonstra. Although he says that, particularly in the Netherlands and at Rabobank, there are other forces at play which might contribute to stability.
I said that the UK was a little bit the odd man out, because most other countries on the continent, banks are not quoted. The idea of commercial banks in retail banking in Germany,
but Wim, you're not convinced that being quoted, not being quoted, is the only impact, no? Rabobank had the same advisors, the same consultants as stock-listed banks. Your bank took the same decisions because you had the same advisors.
And in the end, we had a different risk profile. And it doesn't make you a better bank. I'm not saying that one model is superior to the other, but I think that the financial monoculture, where everybody runs to the same exit at the same time, is by definition less stable than systems which have more diverse governance models, which we have on the continent.
And Wim, if we take this proposal of yours about liquidity buffers, you think that would be a significant step towards further stabilization of the system?
Yes, because in an upswing of the economy, when things are going right, everybody's euphoric. If you as a bank run to your equity buffers, you issue new equity. And because it's very easy to raise new equity in an upward period, so it doesn't really restrict your activities. And I think liquidity buffers that start to bite, of course you can attract more liquidity, but that's costly.
Okay, Arnoud, both, you're not looking convinced?
Let's hear Martin's response.
Okay.
No, I like diversity in the financial system. And I think diversity in the financial system, and Wim is emphasizing one element of diversity, because Rabobank had a different ownership structure. I always had applauded it, but simultaneously I had seen Rabobank, even the board of Rabobank, acknowledging after the crisis, how did we fall into the same trap as other banks? And probably it had to do with the fact that we didn't really have diversity because we had 3 big banks. And real diversity is that you have, for example, you have a culture of regional banks, like the US. The savings and loan crisis in the US was a wake-up call for the US, which basically made the regional banks, the credit unions, small banks, small towns. That culture of banking that the US had really helped the US a lot, because those banks were not linked to the financial market. So that provided for a steady flow of financing to small, medium-sized businesses, while in this country, Rabobank was at the same moment in trouble as ABN AMRO and ING. Not to the same degree, but at the same moment.
Yes. Okay. Arnoud, can you hand your mic to Mr. Wolf?
Okay.
Mr. Wolf, after having heard this Dutch
May I reply
view?
as briefly as I can to these extremely interesting points? So, first of all, on the things on which we agree completely, you spelled out in detail the point I made, which is that in a systemic crisis, which is a crisis which happens because everybody makes the same mistake at the same time and everybody gets frightened in the same way at the same time. The two things happen together. Obviously, I'm not going to fully accept that this is all the fault of the media, but I'm prepared to accept that we might have a small contribution to make. In that situation, so this is a response to what Mr. Dijsselbloem is trying to do, I don't believe for a minute that universal bail-in is what would happen. What you have to imagine is a situation in which, let's say, the 10 largest banks in the Eurozone are all in crisis at the same time because of the exposure to a very similar shock. I don't know what the shock will be. I can imagine some. Do you want me to imagine some? The exit of Italy from the Eurozone and the default by Italy on everything, which then changed to the rest of the system. Yeah, non-zero chance. Now, I don't want to go into this. I can start talking about war in the East. There are lots of risks. One of the most important things to remember about the last financial crisis, which people tend to forget, is the trigger for this monstrous crisis was very small. This was a small financial event that brought down the system. I can spend a long time discussing the losses in the subprime area and what ultimately that triggered. It tells you how fragile the system is. Much bigger crises happen. In this situation, the idea that you would convert a whole slew of debt in a ponderous way, they don't even believe they can do it now, with all the problems about points of entry. I won't even go into all this difficulty in making the resolution work. And then not worrying about what is going to happen to the confidence of people in the banks and to all the institutions, mostly insurance companies and to a lesser degree pension funds, that will be exposed to this. Can you imagine the consequences of it? So governments will bail them in. It's a non-credible promise. Yes, you can do it in Cyprus. Yes, you can do it in Greece. No, you cannot do it in Germany. Sorry, you can't. That's my view. I agree, secondly, that the pressure on banks, particularly joint stock banks, to do for the reasons you discussed, shareholder pressure, is very real. Shareholders don't have a clue. That's their nature. They ask, why haven't you got the same return of equity targets as the bank next door, however insane? To which the answer is, I can do that. All I need to do is double my leverage. And that's how they did it. Andy Aldane has explained that. So they all make the same mistakes. It is crucial, and this links me to the third major point, which comes to the issue of to remember that the banking sector of the Western world is increasingly dominated by a relatively small number, about 25, globally significant banks, all of which basically, I think yours is the great exception, maybe there's one or two others, but I don't know them, are joint stock banks. So while mutuality will be very desirable and diversity of banking system will be very desirable, this train long since left the station. The banking sector of the US, for example, which I happen to know a bit about, is now overwhelmingly dominated. This was not historically true of the US, is now overwhelmingly dominated by, I think, 5 banks. So we have a monoculture of universal, complex banks, which are joint stock banks. That's actually the system we're now operating, and in my view, the regulation strongly protects this system. This leads me to my third point. I agree completely. The end of mutuality and the end of partnerships in investment banking were both disasters, unmitigated disasters, and I would very much like to reverse this. Unfortunately, we thought about this very hard in our work. Reversing this is going from a joint stock bank back to a mutual. It's not clear how you do it. There are property rights here. It's not at all clear how you do it. So again, Rabobank is a great exception. I think this train has left the station too. I wish we could go back, but I don't know how to do it. We've got this world dominated by a 25, roughly, I don't know the exact number, joint stock banks, of which a significant number, and I don't want to embarrass you here because it happens to include some Dutch banks, got into pretty serious trouble when the crisis hit. In fact, the remarkable thing is how few didn't. And 3 huge universal banks of immense significance collapsed. It's absolutely clear. I won't mention their names, I think everybody should know who they are. So this is a world I would like to have, the world of mutuality, the world of partnerships. It's a world that's gone. I agree on the point on ring fencing. It's not a solution to everything. It has 2 great merits. Ring fence banks can go under. One, it will make resolution easier. I'm completely convinced of this because you've got 2 different points of entry for 2 different institutions. And second, crucially, the crucial thing we tried to do with ring fencing, which I believe in, is to significantly reduce the ability of the investment banks associated with the retail banks to fund themselves through and to be backed by their domestic insured retail bank. That might not have mattered in Holland, but it certainly matters in the UK, where 2 of the most vulnerable banks, and there are only 5, had exactly that linkage. Finally, on the anti-cyclical buffers, I may misunderstand you here, but to me, this is the last point, the liquidity that makes banks safe, it actually links with our next discussion, is of course their deposits at the central bank. That's liquidity. Real liquidity is their deposits at the central bank and very short-term government debt on which there's relatively little interest risk. Longer-term government debt as well. But take the safest of all things, their deposits at the central bank. Actually, the size of their deposit at the central bank are determined not by the banks, but by the central bank's operations. That's a crucial point. The central bank determines the deposits that banks have with them. Quantitative easing has been an immensely good way of increasing the liquidity of banks. In fact, it's one of the reasons I like it so much. It has increased the liquidity of banks. In fact, if they keep going with quantitative easing, I'm going to get 100% reserve banking just naturally. But never mind, we don't need to go there. that's another discussion. But the point is that I think it will be perfect. First of all, I don't think that the current level of central bank liabilities are in any way inappropriate. I think they're highly appropriate, even for the current system. There's no reason ever to reverse them. And the sensible thing is to raise the reserve requirements of banks to the sorts of levels that were quite normal in many countries 40 years ago. And furthermore, I think it's completely reasonable for the central bank to conduct operations in such a way as to increase the liquidity of the banking system in good times. And it can do so very easily by buying assets from the market. So the quantitative easing program, which we, back in the old days when I learnt banking, used to be just called open market operations and didn't have this pejorative tones, is a perfectly reasonable way for banks to manage the liquidity of the system. And I have no problems if they increase it, keep on increasing it, and sooner or later we're going to be very close to 100% reserve banks. I don't think we don't need to discuss that now. But I think it's a perfectly reasonable proposal, but remember, it has very profound implications for monetary policy. I'm not going to discuss at all the positive money or other ideas for creating government money, because that's the next subject. But I hope at least I've responded reasonably to what I think was a fascinating, deep and important discussion. Thank you very much.
Okay, thank you very much. All three gentlemen, thank you very much for the moment. And may I ask you to take your seats, and you will be back. But after we have had two short pitches, short presentations. Martin Wolf, I heard him say several times the train has left that station. So the big question, of course, is what is the next station that we might reach? And I'm very happy that we have here tonight Ben Dyson of the Positive Money. And Ben Dyson, I have not been able to ask for his age, but he looks very young. And still, 7 years ago, he started this organization. And with that, actually, I think you can say he started a discussion, or he revived a very old discussion about a very fundamental, different way of organizing our monetary system. And Ben, can I ask you to explain your ideas to us? Welcome.
Okay, so I'll talk about this idea, which is known sometimes as sovereign money, sometimes as full reserve banking or 100% reserve banking. It's an idea that's been around, I mean, really since the 1800s, but in particular since the 1930s, and it's resurfaced as a result of the last financial crisis. And this is quite simplified. I only have 10 minutes. So just to recap, the current system, you have a model where most money is created by banks. The majority of that money goes into the housing or commercial property market, and a large portion of the rest goes into the financial markets. And then some of this money trickles down from the housing market, maybe through estate agencies, into non-financial businesses, into the real economy, whether it's shops or factories or services. Some of that money also trickles down from the financial sector, but a large amount of it does get trapped in the financial sector. And then banks do, I mean, I'm speaking more about the UK context here. It's sometimes different in other countries, but some of the lending in the UK, as little as 8% of bank lending was going to the real economy directly. And this is not really a functional financial system. This is a system where banks are there to finance speculation on financial assets and property. So this is not what we want. A sovereign money system, so it starts off really with the central bank creating 100% of the money that exists in the economy. They transfer this to the government, and then the government can distribute this money into the economy. I'll explain how in the next slide. The key point of a sovereign money system is that money starts its life, newly created money starts its life in the real economy. So you're not putting money into the economy through the financial markets or the property markets, but it's coming into the real economy first. And then people can choose to take some of the money that they receive, give it to a bank, and then the bank can go and invest it, and you still we'll have mortgages and lending to the housing market, hopefully slightly less lending to the financial markets. But the key point here is it's not the banks that are creating money in the first place and deciding where it goes. It's the central bank that controls money creation in a sovereign money system. So I'll just explain at quite high level exactly how this works. The key element of the key feature that allows banks to create money in the current system is that they run the payment system and the lending system as part of the same business model. So you see your account balance and you treat that as money, and when a bank makes a loan, it does that through double entry bookkeeping, simply by increasing the balance of your account. And they can only really do this because they run the payment system and the lending system together. So a sovereign money system separates those two functions together, apart. It separates the payment system from the lending system. And the payment system would consist of what we have called transaction accounts. Now, these would be the payment account that your salary is paid into. They would actually hold sovereign money. So they would hold money at the central bank, which would be completely risk-free. So essentially, it's like having an account at the central bank. Your money wouldn't be available to the bank to lend and invest, and therefore there would be account fees for that service. And then the other side of the banking business would be what we have called investment accounts, which is, if you have some extra money and you want to save that, and you want to earn some interest on it, you give it to the bank and allow them to use those funds to invest. So the key point here is that these would be risk-bearing. So these are no longer guaranteed by the government, which means that the government is no longer underwriting and providing the safety net for the entire banking system, as it does at the moment. The risk would be shared between you and the customer, so both of you have an interest in the riskiness of the loans that the bank makes. At the moment, the government takes all the risk, and therefore people don't care what their banks do, really. This would be an IOU from the bank to you. You've given the bank your money. They're investing it. They'll give it back to you at some point in the future. And therefore, you have to agree when you want the money back or how much notice you will give the bank before you ask for it back. And what this does is it turns banks into the intermediaries or the middlemen that most of us think they are today. So they would be taking money that has been created by the central bank from savers and then lending it to borrowers. And there's not necessarily a one-to-one connection between the saver and the borrower. They still do the maturity transformation, the transforming risk, and distributing risk, which banks actually do quite well, but they don't create money in this process of lending in a sovereign money system. The central bank would now be responsible for making the decision to create new money. So it could be the Monetary Policy Committee, basically the same guys that currently make decisions on interest rates. So in the UK, the Monetary Policy Committee. In the Eurozone, it's the Governing Council of the European Central Bank. The key point here is that because they have this quite immense power to create money, you need to ensure that they're sheltered from pressure, firstly from politicians who are worried about winning the next election, who would have the temptation to abuse this power to create money, but also from the banks and more generally from the financial sector, who would have a vested interest in potentially creating too much money and expanding the economy too quickly. And really the role of the central bank there is to look at the long-term interests of the economy and the long-term health rather than the short-term profit motive or the need to win the next election. How much money should they create? Well, it depends on the monetary policy objective. In the Eurozone and in the UK, central banks use inflation targeting, so they're trying to achieve inflation of around 2%. But you could also follow something like nominal GDP growth or even employment targets. The central bank has the research capacity to look at what it is they're trying to do and make some kind of estimate of how much money they should create to boost spending in the economy to grow the economy by the right amount. Okay. And then the question is, how do they actually put that money into the real economy? The idea is that they would transfer, the central bank decides how much money to create, but the government decides how that money should be used and distributed into the economy. You have kind of a cooperation between monetary policy and fiscal policy. And then some of the options are, either whether it's public investment or spending more money on public services. You could cut taxes, so you leave more money in the pockets of people who are working, and then they can spend more. There's even an idea where the central bank would just divide the money they create between the number of citizens, and everybody would get a grant from the central bank. This idea at the moment has become quite popular in Europe under the name helicopter money. So there's a big discussion now about whether it would be more effective for central banks to give people money, essentially money for nothing, than to rely on the conventional banking system to create money as debt through the housing market and the financial markets. And then a fourth option is you always want to ensure that there is enough credit going to the real economy. And if conventional banks are not willing to lend to the real economy, which is a problem that we have in particular in the UK, there is also the option for the central bank to either finance banks with additional money that they can lend to businesses, or to provide some of those funds to other kinds of lenders, like peer-to-peer lenders, that can get money into businesses, basically, that provide credit to the real economy. You have, whichever of these options you choose, it's a much more direct way to get money into the economy. It doesn't add any additional private sector debt, unlike money creation by the banking sector. And therefore, it should be a more effective stimulus. But also, because you're separating the payment system from the lending system, you're creating a much safer banking system. So that's a very quick overview of a sovereign money system. Okay, thanks.
Leave the stage, one small question, because you have been arguing this system for a long time now, probably to a lot of people from the financial sector as well. So what I'm wondering is there a general reaction that they say this cannot be done, or do they say it's not desirable to have a thing like this because there's all kinds of counter arguments?
There's there's a lot of counter arguments. Quite often these counter arguments are not explained in a lot of detail, so when you start to actually question these arguments, there's not a lot of basis behind them. But there's a lot of questions about, well, this kind of idea that if you allow the government to create money, they'll just cause hyperinflation. It will be like Zimbabwe or Germany in the 1920s. There's a lot of reasons why that argument's wrong. There's questions about how much credit you would have, whether you would have interest rates that would be too volatile. Again, like all of these questions need a lot of thought and a lot of discussion. At the moment, people put them forward as an idea to basically kill off the discussion. So we need to kind of keep this discussion going.
Yeah. So, but it's more a discussion about the desirability of this system, but not that it cannot be done.
Some people would like to say it can't be done, but yeah, I think now we're moving into that discussion about whether this is desirable or not.
Yes.
Yeah.
Okay. Great. Thank you very much. And before we get into the discussion about the desirability, we have a presentation of somebody who has made a whole career of studying the climate and modeling the climate. And when he was done with that, he thought, now I'm going to do some modeling of something which is really complicated, and that's the financial sector. Klaas van Egmond, who, yes. So Klaas van Egmond, who's going to show from his model what might be the economic implications of introducing a system as Ben has just presented.
Thank you, Rens. What if we would follow up the ideas which were presented here tonight by Martin Wolf and by Ben Dyson? Would it be feasible? Could it be done? And what would be the effects on the economy? For such a question, you would like to have an experiment or a laboratory or something like that. And we can imagine that Iceland, for example, would be a nice laboratory for this experiment. And also, after the Brexit, the UK is highly qualified for making experiments about the subject of tonight. Maybe that was the reason to head for Brexit after all. What is more simple and feasible is to make just an experiment in your computer. It's very cheap and simple. And that's the reason why we try to enhance our understanding of what's going on here by making a rather simple computer model. And it looks like this. There is a real economy on the left-hand side, where we have goods and services, and we have a financial system on the right-hand side. And there is a manufacturing sector in the economy, and there's also a service sector. And therein you have production, consumption, labor and capital. There is a market with price formation and all this kind of stuff. On the right-hand side, there is the financial system. And this is described as an aggregated bank balance sheet, a super bank in which all this banking is summed up together. And there you have firms, of course, 3 types of consumers. The upper 2 are consumers buying bonds and buying shares, for example. They are investing. And the middle, the lower category of consumers are just having debt. They are the guys with the mortgages and paying, repaying every month. There is a government and there is the bank itself with its own equity. We discussed during the discussion a few seconds ago. It's also very interesting to realize that money is staying on the right-hand side of the screen. There is no money going into the real economy. It's just staying within the walls of banks. And you're just giving instructions from the left-hand side, the real world, into the financial side to move some things about the deposits on the right-hand side of those of that balance. There are your deposit and liabilities. And of course, we have all these sorts of interconnections, and we have the interconnections between the 2 worlds, between the financial system on the right and the real economy on the left. Now, we scaled the whole thing to the Dutch economy for the same reason as Martin Wolf was talking about. We are a little bit familiar with the facts and figures over there. And then the whole idea is to do the following. To have a model-based understanding of the period 2050 to 2008. And then we should realize that there are a few facts which are interesting. The first thing is that in that period there was an increase in the amount of money of 700 billion euros. That was money which was for the larger part created by private banks giving loans and in doing so creating the money, as Ben told you. The second thing is that the price level, overall price level, went up 8 times. A third thing is that the real asset price level, huizenprijzen, went up 20 times in that period. And finally, that the GDP went up 60 times. So these are a few typical results for the Dutch situation. And the question is how to connect these dots by using this model. Now, the results are shown in the remaining sheets. Okay, then the whole idea is that we are trying to make a forward projection from these data, so that when we are understanding these dots, and we are able to reproduce the situation up till 2008, can we make an extrapolation up to 2050 in the current money as debt system? And if so, can we then change the button to the alternative system in which we have debt-free money, which is produced by the government without debt. And that, of course, is then the third issue. Okay, here we have the amount of money, as we discussed. And you can see here, this is the 700 billion which was then produced in that period. And this is what the model makes of it. It more or less fits what is going on, what has been gone here over the last half a century. This is the price level. The price went up, as I discussed already, 8 to 9 times. And the model reproduces this behavior as such. You can see after the crisis of the year 2008, then there is as a deflation is going on. The price level is going down. It's decreasing. And that's the fear of Mr. Draghi, of course, for when there is now less money produced into the system than it's repaid and destroyed as a consequence. There is less money, so the price level is going down as well. If we should change to the new system, the idea is that there is a criterion. And Ben gave you a few seconds ago, and the criterion which we are using here is price stability. Given the fact that is the objective of central banks in general. So this model is working as follows. When the price is going down, the general price level, then it produces more money. The government starts creating more money and brings it into real economy. And that gives then, of course, more jobs, more work, more whatever. And then the whole system can continue. This is nothing new. In the 30s in this country, we did the same when there was a crisis over here as well. Then the government had made huge projects like new airports, for example, just to keep the economy going. It's a Keynesian stimulation. This is the asset price. This is the idea of the model. The whole thing is here that asset prices are driving the money creation. For, as Dirk Bezemer here in the room described, there has been a change over of financing more firms, and that has been done less, and the increase of lending has gone to mortgages, non-productive mortgages, and you can see the profile over here. And they are the whole system is very sensitive for this real asset prices. And this is the real result. In the 70s, we had an oil price-driven peak, which we cannot model. And this is then the GDP, the final result of our whole economy. And this is the money as this is the real statistics on our GDP. It's running from 10 to 600 billion euros over that period. The money as debt, reality, is describing this profile. We have the crisis over there and a strong drop, and then the whole thing restarts again. As you know, here in Amsterdam as well, asset prices are going up and up. More mortgages, more money creation, and then we go again in the same scheme. And this would be the result, believe it or not, when we are applying the new scheme, then the GDP is just continuing. And the slope of that green straight line on the right-hand side is determined by the technological progress in the economy. This is employment, also a very important factor, although not controlled on employment, but on price stability. The results for employment are encouraging as well. This is the employment in case of the current situation, current crisis, and a predicted next one. And when we are looking into the alternative of debt-free money, then we have an almost 100% employment continued. Finally, there is the question is, who are the winners and the losers of this whole system? In the current system, we are facing the fact that the indebted consumers, the people who are having the mortgages and the borrowers, they are suffering from a drop in their consumption level during these crisis periods. And in the alternative, that drop is reduced as well. So there are many advantages, as you can imagine, from this laboratory experiment. Maybe real-time experiments would make sense given these preliminary results. I have no time for detailed conclusions, so there's only one, and that is that there is an alternative, and it is a very good one. Thank you.
Klaas, also one question to you. Thank you very much for this modeling exercise. But I understood that there has been another model exercise by economists from the IMF.
Michael Kumhoff, yeah?
Michael Kumhoff. Can you say something about how his results relate to the ones that you have found?
In the 10 minutes I had, I forgot to tell him that he inspired us to do our work. Michael Kumhoff from IMF, later Bank of England, has done an exercise with a general equilibrium model. That is a typically econometric approach. We, as environmentalists, are not very familiar with equilibria, so we have done it another way. And this is typically a dynamic, time-changing approach to the equilibrium work he did. And it's complementary, and the results are more or less the same.
Okay, thank you very much, Klaas. And I need to say, I think, Klaas, you mentioned it yourself as well, but this is all work being done with Bert de Vries as well, who's present here as well, but we could have only one presentator. Could I ask the panelists to come back on stage? And now it includes also Teunis Brosens from ING Bank. Okay, I hope it all fits. Yes. Teunis, I want to start with you. We get into the question of the different pros and cons, the benefits and the problems later. But first, I think a very essential question is, can it be done, this alternative as it has been presented? So what would be your answer to that question?
Well, if I can say only one word, it is yes. Yes, it can be done. I think indeed the question is it desirable? What are the pros and cons?
We'll get into that.
Yeah, but it can be done. There are many ways in which you can think of a financial system, and yeah, this is one of them.
Yeah, okay. We all agree with that? So then we can move into the discussion of...
Of course it can be done.
It can be done. Wim Boonstra.
Yes, I think there are basically two points of view here. One from a bank point of view and one from the economy. I think we should be aware that the money creation process, you see it in the banking statistics, but it's the result of millions of transactions a year between clients and the bank. If you decide to prepare to repay part of your mortgage, you're destroying money. If you take on a mortgage, you help the bank to create money. So it's a very dynamic process on an annual basis, or even in the Netherlands, it's about millions of transactions a year, and in the end, the money supply has changed. So it's slightly more difficult than the bank creating money out of nothing. And secondly, the money that's created by the bank is not owned by the bank, it's owned by the clients of the bank, it's your money. And that makes it basically different from money creation by a central bank, which actually, there are no limits there, and they never ever have to repay it. So that's a fundamental difference.
Your point is, it's not just banks who create money, but it's always a bank.
Yes,
with...
but the point here, and that's the second thing, from a banking point of view, it's not that profitable at all, because as Ben Dyson said, in order to do this, you need to control the payment process and the lending process. And the payment system is very, very expensive and growing more expensive anyway. So if there are any benefits from this money creation privilege banks have, it's covering part of the payment system. This is the case in the Netherlands. I don't know about other countries. In the Netherlands we have figures about this, although they are quite outdated. And it's just covering part of the payment system. It's not an incident that smaller banks that can afford to withdraw actually withdraw from this, because they save more money in outsourcing the payment systems to the large banks and just making money out of giving credit. So, and that's so, yes, it can be done. For a banking point of view, it would remove a highly uncertain and volatile part of their funding, because that's what they do, they create their own funding. But if we give a mortgage to a client who buys a house from a client of ING, the money we create is on their funding side, not on that of Rabobank. So from an individual banker point of view, it doesn't make sense. It is not an incident that most bankers don't even realize that they are creating money. They simply don't know, which tell me that I'm failing in my education, because it's actually first year stuff at university. In my education, the lessons I give, in my teaching, I have to say. So from a banking point of view, it would make the whole system more stable. Say, well, okay, let's outsource this to specialized payment services, which is going to happen anyway, because it's not your presentations, but this will come by financial innovations, all the specialized companies that will do what regulators are failing to do. So it's going to happen anyway. And banks just giving credit and attracting money. So from a bank point of view, actually it's not a bad thing. The real thing is how to create, from a government point of view, a money system that breeds with the economy, that is there created where people need money, which is used with payment. And there the system doesn't come much further than the good old Soviet Union, where the Central Committee decided on the color and amount of ladas. Yeah. That's the real difficult thing.
We get to that next thing, but do I understand you right? That you say this creating money, that's not that profitable for a bank to do? So I would be actually in favor, if my bank would have been smaller, that we simply become this bank, like Ben Dyson described, attracting existing money and lending that out.
Well, banks like to have these payment systems because it's a link between the bank and their clients. So that's one of the reasons why they, especially large banks, like to have this interface, in spite of that it's loss-making and it's getting more and more expensive. Try to imagine how much money banks have to spend for IT security today. It's an IT war between banks and hackers. So if you can outsource that, it would make a bank more stable, but you're running the danger of losing contact with your clients. So that makes it difficult point of view. But that is not the real issue.
Okay, thank you very much. Maybe if you can hand that one microphone to the other side. I don't know, Martin Wolf, Arnoud Boot, who wants to react to this idea that money creation, it's sometimes more of a burden than a privilege.
I think, to me, the way the conversation has gone is a little confusing. That doesn't mean it's confused in any way, but it's confusing. I think, I don't see the payment system as the core issue. It is perfectly possible to imagine a payment mechanism that isn't actually run by the banks. They could set up a separate entity. That's not the issue. Money isn't the payment system. So let me be clear what I mean by money, okay, because that's obviously helpful. There are many different definitions, and discuss how it relates to individual banks and the banking system as a whole. So why do people want money? The best answer to that, I think, was given in an absolutely wonderful book on the crisis by Gary Gorton, who's professor at Yale and also was a banker. And the basic point he made is the quality of money is that it is an asset which is different from all other assets in the following sense. You believe that whatever happens, you can buy things that matter to you with it. You will never be in a situation in which you can go to the shops without anything you can trade for. Money is the ultimate store of liquidity for people. It's the definitively safe asset. Right? And it's incredibly important for people to have this, as we realize when you suddenly wake up to discover maybe all the banks are going to close, and I don't know how I'm going to survive for the next few days, or weeks, or months. Now this is not just about us, it's how companies manage their payments, okay? The money that matters, therefore, is the money which people believe, wrongly, banks are holding for them, because they're not really, which they regard as an absolutely safe and liquid store of value, which can be converted into means of payment of unimpeachable value, cash in extreme, at par, whatever happens. That's what money is. Banks create this as a byproduct, quite rightly, of their aggregate efforts to lend. And for individual banks, there is a worry that the money they've created might go to some other bank. And that's indeed almost a definition of a crisis for a bank. And if it runs out of all the banks, then you've really got a problem, because everybody then starts running for cash. Now, the special property of the banking system is that people think the banks are a vault, but of course they're not. The reality is that the other side of the balance sheet of banks is a whole range, as you rightly said, of mortgages, loans, whose value will change in circumstances, and in extreme panic can go more or less anywhere. And it's when people realize that they run on banks. And they can run on liquidity, which is the standard monetary characteristics, or things that are fairly, very, 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 very close to it, like short-term repos and all the rest of it. Things that have very powerful near money characteristics. Now, the instability of the system derives from the fact that people think this is safe and it isn't. It isn't objectively. What makes it safe is that in the extremes, governments will back it. We can replace this with perfectly safe money, apart from the fact that we can destroy it through inflation, but safe in the sense that it's liquid. That would be a fundamental change in the system, but we can do this. The important point, however, I want to stress, I'm not concerned about the payment system. It's the quality that is crucial, which is linked to the payment system because it's money, is that it's perfectly liquid assets for households. But while perfectly liquid assets for households, the liquidity of this from the banking point of view can never be guaranteed as long as it's in a standard banking system.
But isn't that in essence then the problem, that people on the one hand they want to have save their money to be totally safe, and at the same time they want things to happen with their money. They want to have a return on it. They themselves want to lend money from banks. So in that sense, can we blame banks for people wanting two different things that are incompatible?
No, not at all. We have set up a system which has this characteristic. That is the characteristic of the system. It is a system that 95% of the time works great, maybe 97% of the time, and 3% of the time it blows up spectacularly. We come along and rescue it. That has very large consequences because people believe the liabilities of the banking system in aggregate, I agree about the individual, are absolutely safe purchasing power. Because banks can create this as a byproduct of their loans, because the loans by banks in aggregate change, as has been pointed out, asset prices in the economy, in a boom, it is incredibly easy for the banking system in aggregate, everybody doing rationally, behaving rationally, to create incredible quantities of credit and money, vastly exceeding what is stable, and then the system blows up. That is the management problem that the central bank or the other regulators have to deal with, and it is inherent in the system.
Thank you. Teunis Brosens.
Well, we're touching upon a very important area here, and that is that we're talking about money, about reform of money, while in my view the core issue is credit. And credit is when money gets created. And we have had a credit crisis, not a money crisis. So in my view, to fix the system or to make the system more stable, you should start with where it all originates, which is credit, not money. And money is a byproduct. And of course, in a different system, you can separate money, you can separate the payment system from the lending business. But that doesn't address at all the dynamic or the possibility for a dynamic to develop in the lending business, in credit. Because, like you point out, people want a return on their money. So they will keep some money in a public money system. They will keep some money in a payment account for liquidity purposes. But for another part of their savings or their assets, they will want a return. So they will turn to the financial intermediaries, the banks. And we've seen in the past that what these intermediaries then will do is they will try and make the liabilities that are not called money in this case, and the liabilities more liquid and more liquid. This is what happened to the money market funds in the US. So the distinction between money and near monies, the liabilities of the financial system will blur. And in the end, you will end up with a crisis in the lending part of the business, just as you could end up, or we did end up, in a crisis in the current system. So I fundamentally don't see how separating the payment system from the lending business solves any of the possibility of a derailing dynamic in the lending part of the business, of the current system.
Yes. Okay, thank you, Teunis. So you say you can limit the amount of money, but then still within the system excessive credit can be created and therefore can give rise to the same kind of crisis phenomena. Arnoud, can I ask you to react to that?
you're very, because I think the number of dimensions that we are talking about is increasing enormously. Your very first question was, is this doable? This sovereign money.
That was solved, I think.
It was not, because basically the answer was given now that if you try to create that system, then the banking system itself will find another way of creating something that looks like money. And that's that whole near money discussion. So the crucial aspect of this plan, there are all kinds of negatives you can say about it that may not be solvable, like that the government find this a very cheap way of funding itself, and that all fiscal discipline is gone, which is a critical thing to think about in this plan. But the key thing about this system is that you can control the banking system from doing something that they are basically doing today. And that is that they will find near money, like Gary Gorton, the repo type financing, they will find substitutes for it. And once they find substitute for it, you still have the same instability in the banking system as you have today. It might be even worse, because in that case you have two alternatives, and you will see that in times of crisis, the money will run out of the banking system because the near money doesn't look very good in a crisis. So the money will run out in a crisis system. And actually, by combining both worlds, because that's the risk of if you move to sovereign money, because of all the lobby powers that Martin was emphasizing, it will be impossible to prohibit banks from doing something they want to do. They will find a way. So you are getting in a dual system, and the key characteristic of the dual system is that it will be public. Literally, the money will be public in a crisis, and it will be private outside the crisis. So in euphoric periods, banks can finance themselves as cheap as they want with near money. They can blow up the credit system as they have done today. So you can never choose the middle. So being in the middle is the worst you can be. So if you believe in this system, you have to be absolutely convinced that you can control the banking system from financing themselves short term. You have to be in a system where the banking system is really well capitalized, that they basically internalize all the risk, and therefore you can get rid of something that looks like deposit insurance or too big to fail, whatever way. And if you cannot do it, you have to stay away from this process. But there is one thing, and that has not been emphasized, nor in the first discussion as in this discussion. We are talking about the banking system, and Martin, you in a sense as well, you're talking about the banking system as if this is the banking system that we have. We now have to find ways to regulate it in a way, provide anchors in a way that the banking system will be sustainable towards the future. And what do we need for it? You are skeptical about it. I'm skeptical about it. But there is another reason that we have to look at the banking system. And that's the very reason why the banks currently are laying off, like in this country, 70% of their people. Why are they laying off 70% of their people? Because they are becoming inconsequential in many of the activities they are doing. So the banking system that we look at, and that we look at from a stability perspective, actually there's a fundamental change in business models going on. And how do we accommodate new players? And there, theoretically, this proposal has great attractivity, because if it is the central money creation, you can have a level playing field between the new players and the existing players, if that would be possible.
Yes. So that's an added pro of this system, but I'm still with my very first question. Can we do it? Because you said we
cannot.
Can we control for these quasi monies that will arise? I'm going to Klaas and Ben in a moment. Is about this point, Wim Boonstra?
Yes. Well, I started my first. Yes, it can be done. So let's have a hypothetical world that all banks say, okay, let's do this. It can be done, and it's not a payment system which is in danger. It's just it becomes much more expensive because it has to be completely covered by fees and that kind of stuff. And banks can do what they do. They attract money and they become but you don't solve the problem. And also not your problem, but you also don't solve the problem of debt creation. Even in a constant money supply, you can have debts. And the idea that you can have debt-free money is fundamentally flawed. It cannot be done. Even in the Bible, the book of Leviticus, you can read about this. Simply because your debt is someone else's assets. So even if you have a jubeljaar, everybody has the same amount of money, everybody's happy. People start, some people have more money they can use, they lend it to someone else who wants to buy a house, and you build up debt in the context of a constant money supply. The whole idea is flawed.
Wait, which idea is flawed?
That you can have the debt-free money.
You can have debt in the economy without money.
Debt-free money. You always will have, the moment you have money and you have interactions between people, you have debt.
Yeah.
And assets, because a debt of the one is an asset of the other. So the whole philosophy, let's create a debt-free society, well, I dream of it, but that cannot be done.
But nobody is saying that, no?
Yeah, oh yeah, I heard it earlier this evening.
Martin Wolf.
With that. It depends. Maybe I misunderstand this, so I'm being educated, but my view is this. You can't have a debt-free society. Okay, well, you can, but it would be a very stupid society. So that's not what we're interested in. But money is something else. To me, what do I mean by money? So I think it's perfectly possible to have debts that don't have money-like characteristics. So the value of the debt floats up and down with the market, and what you get on any given day depends on its market value. That's how most debts work, right? Money is a very special sort of debt. It's a debt issued by, to me, a debt issued by an intermediary to fund a set of assets that go up and down in prices, whose characteristic is that the issuer of the debt, in this case, the bank, but it could be some other entity, we're already talking about near monies, promises that this debt will be redeemed to you at par, that is to say, at exactly the same value as you put in, whatever happens to the value of the asset, the debt, at the other side of this transaction, instantaneously. That is to say, it is freely and perfectly liquid. It is the properties of being valued at par and being perfectly liquid that make a debt liability money. It is perfectly possible to have an economy. I can give you some examples. Larry Kotlikoff wrote a whole book about it. He's not an idiot. You might not like it, in which the essential characteristic is that if you put your money in this intermediary, I can give you many examples, the value of that account goes up and down with the value of the assets on a second-by-second basis, if you want. Now, you can choose to regard it as money because you think that the assets on the other side are safe. And that's what they thought with money market accounts. I'll come to this in a second. But for most assets, actually, debts, mortgages and so forth, their value floats up and down. That's what you would expect, depending on risk. So the promise to redeem at par, in my view, is a fraudulent promise, and it shouldn't be allowed. Now, so the solution to this problem seems to me relatively straightforward, though it's very, very intrusive. You can have a debt economy. People can hold debt. But an intermediary can't make promises it can't keep in all states of the world. And the intermediaries in this case do. So you make those promises illegal. Now, very intrusive, those promises disappear. So the money-like property of debt disappears, other than central bank or government money. The money market funds were an interesting fraud because they made an implicit money-like promise against, it must be admitted, what seemed to be very safe and very liquid debts, very short-term and very safe. But they weren't perfectly safe and they weren't perfectly liquid, and the institutions were allowed to operate what was in fact a banking business with no capital whatsoever. In very exceptional circumstances, they broke the implicit promise. There is an interesting question what you should do about, what you should have done about that. My own view is that sort of promise should have been made illegal. Obviously, the implicit analysis to me that we're making here is there are promises that people shouldn't be allowed to make because private businesses cannot make them without government support. And if private businesses cannot make them without government support, they shouldn't be allowed. But this is a fundamental issue. We can have banking as we know it, with debts which are converted on the liability side into money, but we can only do so if we rely on the central bank to make that promise good. And that is a very, very destabilizing promise. So I agree, we definitely don't want an economy without debts. The question is whether we want debts to have money-like characteristics. And that, I think, is at least very questionable.
And And Mr. Wolf, if we would prohibit these false promises, would that be a solution to the problem of these near monies that we just discussed?
It would be a partial solution. I cannot prevent people from believing things that nobody promises them are true, which are not allowed to, or believing because they would be textually illegal promises. You cannot make it. You would not be allowed to make a promise that you can redeem something at par. But if people believe something, it is crucial. That's why the money market fund is so interesting, though not the dominant story in the case of the last financial crisis. The money market funds were allowed to give the impression that the buck would never be broken, even though there could be no guarantee that it would never be broken. Now, should that be made illegal or not? I don't know. But I'm not suggesting for a moment that people can be prevented from believing false things because they do. But I think we can create a system in which we don't allow financial institutions to make explicit promises which we know in important states of the world they can't possibly meet.
Okay, thank you very much.
Which, by the way, equity, if you buy an equity mutual fund, you know exactly what you're buying, which is the price of this mutual fund, its value is going to go up and down with the market, and nobody can make a promise otherwise. It's perfectly sound, perfectly realistic, and you bear the risk.
Yes, and that's more or less in Ben Dyson's model what happens to a bank. They become...
A bank can invest in far safer assets with far less...
No, of course, but you know it can go down.
But yes, but you would have a choice. But when you're investing, it will be clear that when you're investing, you will be bearing a risk, and the risk will be a risk of loss on those assets. And it is perfectly valid to argue that we would lose, and this is the core argument, we lose economically important opportunities that come from the fact that we have banks that are able to make these promises which allow an enormous amount of transformation in our economies which would not otherwise occur. But if that's what we want, we have to understand that crisis will go with it.
Okay, thank you very much. Klaas van Egmond.
Yeah, continuing along these lines, the question is, why are we trying to control banks who say that they are so complex that they cannot be controlled? In such cases, we are just relying on the markets. There are markets for. Markets are controlling very complex affairs. So I think that in this whole debate, the entanglement of public and private, Martin Wolf already noted that also, is the key thing. And if we make that separation, and when the public government is making the money, according to the requirements over there, and when the private banks are just brokers on the financial markets, we don't have to worry about all these things, about near money, etc. For that's then just up to the market. When you are buying a car at the wrong garage, it's your problem. When big firms in Europe or in the world are going bankrupt, we don't care at all. Why should we care when banks go bankrupt if they are brokers on the market? So the entanglement is a problem. We will never be able to control these complex things. Leave it to the market.
Okay, Klaas, thank you very much. Actually, looking at the time, we are already in the closing statement sphere. So I will ask all of you for a closing statement. I had to promise Martin Wolf that Ben Dyson would get the last word of the evening. Teunis, can I start with you?
Well, my closing statement is still back to this discussion. I spent a few years at the Dutch Authority for Financial Markets, and what I learned there is that consumers are short-sighted and they know very, very little about finances in particular. So I think that if we have this system between money and near monies, of course they won't make any promises, but after 5 years people may still remember the financial crisis, say we have to be careful when investing in these financial intermediaries. But it may take 10 years or 15 years, people will forget. A crisis will come and everybody will again look at the government to bail out these financial intermediaries. So again, I do not see how public money solves this credit instability.
Very clear statement. Wim Boonstra.
Two issues. I think one of the basic mistakes is that the only safe bank is a bank with 100% liquidity. Because it's just one of the functions of banks to make illiquid items liquid. That's what they do. if you go back into the theory, I would say read Irving Fisher, 1911, The Purchasing Power of Money. He explains very fine. It's nothing new. And of course, more liquidity is safer, but then you reduce the transformation function. So it is more complex than it comes out in the discussion. The second thing, if you would do this and banks become brokers, you just shift the risks from the one part of the economy to the other parts, being the savers. Because this intermediation, you still have difference between people that have their savings account and they want to go to the bank and be able to attract the money immediately, and on the other part of the balance sheet of the bank, companies or people that have loans with maturities of 30 years sometimes. There is a mismatch there, and actually it's one of the tasks, one of the added values of bank, to do this, to bring these things together and to manage the risks. And of course they made serious mistakes there, so it could be better, but don't think that the whole system becomes more stable if you simply shift risks from the banks back to society. And this is one of the reasons why this whole Chicago plan of the 1930s in the end didn't mean it, because if you look closer to the plan, it doesn't bring much stability at all.
Okay, thank you. Martin Wolf.
I suppose I should respond to that. I mean, it seems to me, with the greatest respect, Wim's a good friend, but I think this is quite an important mistake. Society bears the risks. Society always bears the risks. Banks bear the risks to the extent that their shareholders, who are a small subset of societies, are able to bear the risks. We have already agreed if the shareholders are not able to bear the risk will be put on the rest of society. Now, the risks that banks are bearing are very large. We've already agreed on that, I think. Namely, they're holding a very large number. I won't discuss how they created them and whether it's socially useful what they've done, because I'm very with Adair Turner. I don't think they are mostly. But they've created an immense number of long-term, relatively long-term and illiquid debts in the economy, mostly secured by property. And they have, on one side, and on the other side, they have immediately liquid liabilities redeemable at par. The side with the assets has inevitably highly fluctuating values. The side with the liabilities doesn't. I think we can agree that as structured now, the bit of society which can be called the shareholders of banks cannot bear those risks. They just don't have enough shareholders' funds to do so. If we don't want to go to the sovereign money solution, and we do want a private banking system, then I am completely with Anatad Marty and Martin Helvig. They have to have enough equity to survive pretty well anything plausible. As they are now, it is absolutely clear that the risks are borne by society at large anyway. I would like more of the risks to be borne explicitly by the people who make the loans. Who are ultimately the households. That's impossible to do as long as what they think they're holding there is money, for reasons we've discussed. So the solution to that, and I agree there will be risks of near money, though I think they're perfectly manageable, the solution to that is to make sure that there's a large enough quantity of genuinely safe assets they can hold, which they can treat as money. And for the rest, I'm afraid we have no better arrangement, in my view, than the market. And that means, of course, losses will be borne. In a system in which there's a lot of really safe money, I think we can take the risk. As it is now, with the core financial functions borne by banks, we can't take that risk. They will be bailed out. We know they'll be bailed out. That's why they don't hold any equity. And that's why they're very dangerous. And this is the fundamental problem we have created for ourselves.
Thank you very much.
If there's one thing clear, and I think also one thing clear from the discussion tonight, it is that the financial system is basically in the wrong equilibrium. And you can question whether it is an equilibrium, but it is an equilibrium from the participants in the system. The participants in the system hold hands, and they're basically trying to preserve the system. And they are against moving to a new type of equilibrium, because the new type of equilibrium is basically very clear. New type of equilibrium cannot be that you, what Martin was indicating, I don't think it can be that you prohibit them from making promises. That's key to any type of business activity, that we make promises. And whether you can keep the promises or not, that depends on your reputation, depends on your level of capital, etc., and whether the party on the other end believes in your promises. And if we know one thing, human nature in euphoric times, risks are underestimated or ignored, and in more dreadful times, risks are overestimated and overpriced. So in good times, risks are always underestimated. The society in good times does not require financial institutions to have capital in good times because they underestimate the risk. So there's a pressure to have less risk, less capital. So ultimately, what the solution has to be, is a new type of equilibrium. And the new type of equilibrium, I think, will be, you mentioned the name of Martin Hellwig. The new type of equilibrium is an equilibrium with much more equity in the financial system, much more equity, risk-bearing capacity in society at large, basically, because it's not just the banking system, society at large, much more capital. At a higher level of capital, you basically have the right incentives. At a higher level of capital, you internalize the risks you are taking, you can make mistakes, and basically the problems, the systemic risks are much more limited. You might have a problem, but at a higher level of capital in the system, the likelihood that simultaneously the rest of the industry has problems is much lower at a higher level of capital. So we are at a very low level of capital in the system. At that very low capital, we know from corporate finance theory, we have a debt overhang problem. Low levels of capital means that institutions have even an incentive to have even less capital. Capital is very expensive, so banks are right. At a low level of capital, capital is very expensive because by having more capital, you basically reduce the subsidy that you're getting from the government. So we have to move to a much higher level of capital in industry. I think that has to be advocated at the end by governments, that's the optimal thing to do. And from that high level of capital, you will see a clear improvement in behavior. And how to get to that situation, from a situation of low capital, it has to be government interference. It will not be the institutions themselves. So we will remain in a low capital system as long as governments are not willing to act.
Okay, Arnoud, thank you very much. Before you can hand the mic to Ben Dyson. No, Klaas. Yep. I think the consensus here on stage is that there is no easy solution, and actually, but I think there is quite some agreement. We didn't ask the bankers about it, but I think you also agree that more equity in the system and also at the banks would be a good thing. And of course, the question is how high should it be? But we're not going to end this evening about sovereign money without giving the last words to Ben Dyson to make his case for last time. What did we miss here on stage? I must say I had on my paper a lot of both pros and cons that we did not get into. So maybe we lost the real arguments in favor of sovereign money. But Ben, for you the last words.
Well, this is obviously complicated, and it's a discussion that will go on for a few years, I think. But I think it's worth, if you think back to the survey that you showed at the beginning, the majority of people in the Netherlands believe that either the government or the central bank is responsible for creating the nation's money. Now imagine that was the case, and the government put forward a proposal to actually transfer that responsibility to the commercial banks. And they said they will be allowed to create money every time they issue a loan. And they'll have bonuses and commissions and incentives to create more loans, because that's what they do in the market. And if it does all go wrong, the taxpayers will have to rescue the system. Now, the idea that people would actually vote for that is unthinkable. And I think this is the current model of banking, where you combine payments and lending, which allows them to create money, developed over the last 200 years. It made sense in the 1850s when we didn't have computers, we didn't have technology. But you can now separate lending from payment, and you can separate the issuing of loans from the creation of money. And that is completely technologically possible. It may even happen automatically over the next 10 or 20 years. So I think we're defending a business model that made sense at a time, but no longer is useful and is no longer working for us. And I think that's why it's worth thinking about what comes next. So, thanks.
Okay, Ben, thank you very much. Well, what comes next, by the way, is that we are going to talk further about this topic tomorrow for a whole day at the Dutch Central Bank. Thank you also for reminding me about the Motivaction research, because I forgot to tell in my introduction that there are a few copies of the research available, and Martijn Lampert of Motivaction will distribute them at the back with the sign of Motivaction. Thank you all very much for your coming here and your listening to this interesting discussion, which of course is not finished, so I can only say to be continued. Thank you very much.